Welcome. In this explainer, we're going to break down a really powerful strategy that the pros use all the time. How to use stock index futures to shield your portfolio when the market gets choppy.
So, let's put you in the driver's seat. Imagine you've built up this amazing $5 million portfolio, but you're looking at the headlines and things are starting to feel a little shaky. Now, you could sell everything, but that's going to trigger a mountain of transaction costs, not to mention taxes. So what do? Well, it turns out there's a much smarter way to handle this, a way to keep your stocks and protect yourself from market risk.
All right, before we can build our protective shield, our hedge, we need to know exactly what we're working with. So let's lay out all the key numbers that are going to be the foundation for our entire strategy.
Okay, here's our starting point. A well-diversified stock portfolio that's currently sitting at a value of just over $5 million. This is the nest egg we need to protect.
Now for probably the single most important number that describes our portfolio's risk. It's beta. In our case, it's 1.5. So what on earth does that actually mean?
Well, beta basically measures the kind of risk you can't get rid of just by diversifying. Think of it this way. A beta of 1 means your portfolio moves perfectly in sync with the market. Our beta, at 1.5, means that if the market drops by, say, 10%, we should expect our portfolio to drop by 15%. So yeah, it's riskier, but on the flip side, that's why it has higher potential returns when the market is climbing.
And finally, let's get a quick snapshot of the market itself. We're using the S&P 500 as our benchmark, and it's sitting at 1,000 points. A futures contract on the S&P is priced just a bit higher at 1010. We're also going to need the risk-free rate and the dividend yield to make our calculations accurate, and that's it. With these numbers, we have everything we need to get started.
Okay, we've got all our pieces on the board. Now it's time for the strategy. Our goal here is to figure out the precise number of futures contracts we need to short to basically make our portfolio immune to the whims of the market.
And the key to this whole puzzle lies in this pretty elegant formula. N star, that's what we're solving for, it's the perfect number of contracts to short. And you find it by taking our portfolio's beta and multiplying it by the ratio of our portfolio's value, which is VA, to the value of a single futures contract, or VF.
So let's plug in the numbers and walk through this. First things first, we need a value of one S&P 500 futures contract. The contract has a standard multiplier of $250. So we take the futures price of 1,010, multiply it by 250, and we get $252,500. Simple enough. Next, we just plug everything into our formula. 1.5 for beta, our $5 million portfolio value, and that contract value we just found. That big fraction simplifies down nicely to 20, so it's just 1.5 times 20, which gives us our final answer.
And there you have it. The math is crystal clear. To perfectly hedge our $5.05 million portfolio with its beta of 1.5, we need to short exactly 30 S&P 500 futures contracts.
So we've designed and built the hedge, but, theory is one thing. The real question is, does it actually work when things get real? Let's put this thing to the test and simulate a market downturn to see how we did. Okay, let's fast forward 3 months. And just as we were worried about, the market has dropped. The S&P 500 has fallen a full 10%, from 1,000 down to 900, and the futures price has fallen right along with it. Now, if we hadn't put on this hedge, our portfolio would be in a world of hurt right now.
But we did hedge, and because we went short on those futures contracts, we actually make money when the price falls. The price dropped by 108 points, so we multiply that drop by our 30 contracts, and then by that $250 multiplier, and would you look at that? We've made a gain of $810,000. Not bad. All right, now for the other side of the coin, the part that's not so fun, the loss on our actual stock portfolio. To get a really precise estimate, we use a tool called the Capital Asset Pricing Model, or CAPM for short. It's a fancy way of saying we're accounting for the market's drop, our portfolio's high beta, and other things like interest rates. And when you crunch the numbers, it predicts a very specific and painful drop of 15.125%. So that percentage translates into a real dollar loss of more than $763,000. Ouch! That brings the expected value of our stocks down to just under $4.3 million. Yeah, that's a serious hit. But wait, remember that huge gain we just made on the futures contracts?
This is the moment of truth. What happens when we take the painful loss from our stocks and combine it with that big, fat gain from our futures hedge? Let's tally up the final numbers.
And here it is. This is where you can really see the power of a well-built hedge. We take our beaten-down portfolio value of about $4.3 million, and we add back that $810,000 gain from our futures. Our total position value at the end of the day is just under $5.1 million.
Let that sink in for a second. The market absolutely plummeted by 10%. Our high beta portfolio should have lost over 15% of its value. But instead, thanks to this hedge, the total value of our position actually grew a little bit. We essentially earned the risk-free rate of return, almost as if our money had been sitting safely in treasury bills the whole time.
You know, this quote from the source material just sums it up perfectly. By hedging, we completely took that broad market risk off the table. We neutralized it. And what that does is protect our capital from a big downturn like the one we just saw.
So what's the really big takeaway here? We just watched a hedge turn what would have been a catastrophic 15% loss into a small, stable gain. And I think what that shows is that market risk, it's not just some force of nature that you have to sit there and take. With the right tools and a little bit of math, it's actually a variable you can precisely manage, control, and even completely neutralize.